as developers needed to change. We needed to reinvent ourselves. And you'll hear me continually saying reinvent, because you can never stay the same forever. You need to continually look at your products, change them, improve them to stay ahead of the game. And I think that's what we at REIM have managed to do. The late 1980s were still not democracy, but we could see what was happening. Murray and Roberts had large land holdings in the townships across South Africa, in Durban and especially in Johannesburg. This is Alex Zandre. This was on the other side of the river. They had 700 plots. We built a beautiful show village, furnished it, presented it beautifully, and in 2 months we had sold all 700 houses, showing the pent-up demand for housing in the new, what was to be our new emerging market. And we talk about BE. We did BE before it was even invented, because we did it because we wanted to do it. We wanted to make a difference. Jeff Mashicha was our partner there from Soweto. The 90s come and go. We also understood that government was, the parastatals were starting to look at alienating land. The first one was Intersight, who controlled the land around the stations in South Africa. And we saw the opportunity of putting shopping centres at the stations where the communities could walk, pick up their goods and go home. And we, together with KK Kombi, there's a picture of him there, developed the Younger Shopping Centre, the Younger Junction, which fits between Gugulethu and Manenberg, right in the middle. 1989, heart of apartheid, limpet mines, but we were there, boy, we were there. Now, try to explain to your anchored tenant, Pick n Pay, that you want to show them a site where their future lies, and you want to go into Gugulethu, just take a walk around the station, and that was the easiest deal, because it was done before I even had to go anywhere. They were scared, nervous, but it worked like a bomb. So, okay, this gentleman, KK Zutulele Kombi, was a partner of ours. He arrived at my house in a taxi in 1989, and he said he's got a vision. He wants to do property. He hasn't got a clue how to start it or do it or get involved. And we went and did many things with KK on a 50-50 basis, and we still today have a great relationship with him. Right, then came the exciting times, the release of Madiba, and how could we make a difference? This was another shift. How could we develop housing on state land? So what was the anchor that we could try and get the numbers to work? And of course it would be the poorer communities. So if we could take the guys that were living in shacks, move them out of the shacks, provide formal housing for R1 on a big tract of land, state land, and Marconi Beam was one, 300 hectares, it was owned by Telkom. Do the urban plan in a mixed-use area so we could bring people back, instead of pushing people away, bring people back to the cities, bring back people back to the place of work. We rehoused 20,000 people and built 4,500 houses together with the facilities and unlocked 280 hectares of industrial land just outside Milnerton. Now you can imagine the first meeting between the guys on the left who were living in the squatter camp, very PAC, ANC was conservative, and on the right-hand side, the very verkrampte oaks who've lived in Milnerton all their lives. So I was the chairman of the meeting. They came to the town hall. We were going to present the plan, how we were going to rehouse the squatters on the land in Milnerton. They weren't going anywhere. So the guys arrived from the right wing with their R1s and all they opened the boot to show me, and the guys on the left, they arrived with their machetes and everything. And we had a very interesting meeting, but at the end of the day, we had arrived at an urban plan where everybody accepted that we were going to do this, and that's what happened. About 10 billion rands worth of development, and it's there to be seen. So that just took, the land was owned by Telkom, and Madiba opened it up, and he reiterated on the site the kind of partnership and reconstruction and development project that was needed to transform the newly democratic South Africa. So just remember where we're going wrong on housing policy in this country. You cannot produce housing for the poor without having an engine room that's going to support it. Now, whether that be the government in the form of subsidies, whether it be land that's cross-subsidized, it has to be thinking out the box. You can't just build a 20 square meter box in the middle of Soweto and think you're going to solve your housing policy. It's not going to work. And off we went. So we carried on that model to Westlake. Westlake is at the end, for people in Cape Town, was the end of the Blue Route. And we all remember the Rockcraft squatters that were all over the site, living in the two disused hospitals. And I went to see the then councillor, and I said, look here, what we want to do here, we want to move the squatters into a formal housing situation and rezone the land for a mixed-use development. And he said, well, we can't do that because it is state land. So I said, well, put it out to tender. Ask for a development facilitator who's got the skills and the capital to be able to do that. And that was done. And who would have thought that we could have 10 million rand houses on the one side, and right next door we could have people who got their houses for R1, right next door the American Embassy, and right within the confines the Redden Private School. It won many national and international awards for UPSI, SAPOA, and we all know where Westlake is. So another very successful project. Big Bay came next, also public-private partnership. We went to the city. It was a big tract of land where around the beach, and we did a joint venture with the city, and we made them a lot of money, and we upgraded the entire area. And Big Bay is what you can see today, again, working with the public sector in an open and transparent way. We couldn't sell the land out of hand because it's state land. So none of these projects did we actually construct. So we devised a system of a lottery with a wheel, and everybody got a number, because we had people queuing and waiting and sleeping over for 7 days, waiting just to get a chance to buy a property here. And we had our big wheel, and off we went, and we alienated all the land independently. You talk about 10 billion rands worth of development. Then that was followed by the Fernkloof in Amanus. Amanus desperately needed funding to upgrade the infrastructure. If you go to Amanus, you'll see the whole town has changed to this Village township, which needed major housing upgrade. Amanus were very forward-thinking. They had the golf course with land, not inside the golf course, but around. There were 7 precincts, 330 plots. It took us 7 years to do the rezoning, the EIA. When somebody of 95 sends you an email and he's retired, then you know you're in trouble. So, and then finally, right at the end, we had a major issue on the review on the EIA, which I'm going to get to, the planning problems facing us in this country. Nevertheless, we stuck in, and over the 2 days, we had it over 2 nights. All 344 plots were sold. 20% deposits were paid. Infrastructure is put in. Amanus today, you can see it is a magnificent 27-hole golf course. The municipality received about 70 million rands plus minus for its infrastructure. It upgraded sports fields for the schools and all those other crucial infrastructure projects that need to upgrade cities and towns outside of your major urban areas. All right, this is, people talk in your lifetime about a boom or something that you can't believe in terms of demand. Now, we could see it coming in the late 90s. The interest rates started to come off a bit. We could see that our house prices were low. Land was difficult to rezone. It was difficult to get through our planning, and our environmental laws are horrific in this country. We have laws that would make Australia look stupid, but yet we're living in a 10th world country, and I'll deal with that later. Thus, the blockages to get things that we stuck, and we'll deal with that. So, the early 2000s, the banks started to open up the floodgates for finance, biggest boom of our generation, and developers were selling out in hours. Then, they called it the deal of the century. 2004, we bought Century City. Now, Century City was owned by the banks because Monex had started it, had built a canal walk and the theme park, had spent R1 billion, and they had got into trouble, had gone bankrupt, and Nedbank took it over. And we were quite sure about Century City. It was just like in the middle. We were more southern suburbs and northern suburbs. And but we knew it was a great site. So what happened was we bought it for 120 million rands, and that was 1.4 million square meters of bulk. That is what Century City is, and I'll show you the pictures. We are currently at about 950,000 square meters, so we've still got 500,000 still to go. And it is to build a city, and that's what it looked like when we bought it, or when we got involved and acquired it in 2004, is the most challenging thing, because When you have a bag of rights, and this is the genius at the time of the local Bloberg Council, you have rights for 1.4 million square meters of bulk, so you can have commercial, can have retail, residential, and you can make a city. You can build a city properly from within. You're not adding in and putting in, and doing urban renewal. This is something that is a jigsaw puzzle. And in that period, Century City has developed. And as I say, 950,000 square meters of built form. We go up to just close to 1 million now with the building of the convention center, 1,000-seater convention center, another 190-room hotel, parking garage. And added to all of that has come a very successful Currow school of 1,300 kids, hospital, very successful Oasis retirement village, all working together to make the city work. We've built over 4,500 apartments, and there is less than 1% of units available for sale. So you can just imagine the demand to be in the city. And plus, Century City offers incredible value. We're selling at 23,000 rand a square meter, compared to anywhere else is incredible value. Some of the pictures that have been taken. The Island Club was the first residential project. You can see Canal Walk on the left. 450 units. We had sold them out in 3 months. And those units which we sold for 600,000, today 2.5 million rands. So people within Century City have made money. Property owners have made money. Commercial property tenants who've bought offices from us have made money. It's a growing city. And the other thing, we have Century City Connect. We have our own fiber optic network which runs around. Our internet accessibility is the best in South Africa, and let alone I think probably in Africa. So all of these things, what makes a city tick? Restaurants, vibe, people want to be there. Convenience, we've got the My City right through. You move around that city very quickly. We've got 12 kilometers of canals. People use those canals to access various places. And then, of course, most important at Century City, this was the Knightsbridge project. Oricon is the first green 5-star building in South Africa. We built for Oricon, the engineers. It's complete, and that's the extension to Oricon, which will be happening shortly. It's an extra 5,000 square meters. Century City Central Park, that's where the hospital's gone. We've got a day hospital to do, not a hospital that you can have only procedures done, you can stay overnight, big demand. And we're getting the medical fraternity to come to Century City now, where they're there. It's also very exciting for us. And that's it in 2014. So you can remember it was just blank. And if you look at Century City, in the middle, we have our own Central Park, 16 hectares of wetland, which we've reinvigorated. We've worked with the environmentalists from the city. We have a whole environmental center there. We get 50,000 children coming through every year, where we're looking at all the green issues in terms of the environment. And we've got paradise for bird watching. People come from all over the world to see the birds here when they migrate from Europe. And it's a very, very important part of the open space living at Century City, is that magnificent park. Right. Post-Century City, in 2011, I decided to take it a little bit easier, which wasn't good, because I still had a lot of energy and I wanted to work. And I decided to form my own private label. And what that meant was, where would I go and where did I see the opportunity? So at times, 2008, the market had crashed. We all know about that. And where was going to be the next gap? And I identified the peripheral part of Cape Town, which is Vredok, Tamboerskloof, Greenpoint, and Seapoint. And I realized that these areas needed to be upgraded, but they were prime areas because they were right in the city. So we always look at where are your prime residential areas relative to commercial. We call them areas of tension, where there's tension between commercial and residential. That's the line. That's where you want to be. So off we went and started in Vredok. We assembled a lot of our team, and we bought a property, and I decided, let me build it. And we finished it and we furnished it. That was the old house. That's what it looked like. And then, of course, that's what it looked like when it was finished. So now we're 2011 to 12, the market still flat, But as we finished it, we were able to sell the 5 apartments. But I knew that the market, it was still cheap. We were selling at the 30,000 Rand a square meter level. But we couldn't stay there, but things were starting to get better. We could feel a bit of a groundswell. I wouldn't say it was anywhere near 2001, but the market was improving. Now, I know Erwin is probably going to say, Mr. Ruud is going to say to you, I should have listened to this guy, because he's probably saying the opposite thing at this time. But we are entrepreneurs. So we're looking for the gap. Where could we take our name and our brand and our capital and go produce something that we're not where we at Central City or we were in the northern suburb? That led to others. Of course, our package is to furnish. We spend a lot of time in the decoration of the units, in the detail on the architecture. When people walk into a Rabi apartment or a signature Rabi, it's the same. It is world class. Wow, you knocked over. And the package together with the furnishings is what sells our products. We then continued with the Outlook, which was next door. It was 5 apartments. Again, you can see some of the interior decoration shots. We're always trying to make and better our offering to the marketplace and always selling value. We never sell at the top. Even if we can take the top, we're always going to be able to offer value, and that's why we have such a huge investor following and have over the years. People have stayed with us for many, many years and made money. Little block of flats, Erwin renewal. We took off the roof, we cleaned it, we put balconies on, and we sold those apartments for 1.5 million. Here's another one in Freedom, 45 on extra. Prices started to go up. We were around the 3 million Rand range here. We then moved to Sea Point. Sea Point, and at the same time, ironically, in 2012, the city brought out a new zoning scheme, and that has made a huge difference in these markets because it allows better flexibility and better use of the land. So you don't and are not caught up in going to neighbors in the side spaces. You're allowed to build on boundaries, so you're not getting delayed and there's trauma and you're never able to get your projects off the ground. That was in Sea Point, Missouri. The future developments coming up are Ivanet in Fredericks, 11 apartments. The Richmond is a Greenpoint Main Road. These are all under construction, by the way. The Reserve in Upper Sea Point, you can see we like the 7, 8, 10 unit schemes. People like small body corporates. People who are buying here are scaling down from big homes in Sea Point, Clifton, Camps Bay, Bishop's Court, Constantia, wanting lock up and go. Big market. So you can't build a 60 square meter 2-bedroom unit because they won't fit their lounge furniture in. So you've got to build nice sizes and give the quality. There is a big, big market. And whatever we have, we sell very, very quickly. Off the plan. The address in Avenue Le Sueur, also very successful. The residence right next door, the Alga Kirk, there were 30 units together. This is right in the middle of Sea Point. So Sea Point is changing. Sea Point is being renewed. Sea Point's main road is being cleaned up. And because it's a popular area, people want to live in Sea Point. 10 years ago, Sea Point didn't have cut. It was degrading. Renewal wasn't taking place. Cities can't take, towns don't stay the same forever. You've got to keep on looking after them. And this is what urban renewal is about. 53 on Kloof, also up in the top part of Sea Point. The Chelsea is opposite Manno's. Everyone knows Manno's in Greenpoint Main Road. Greenpoint was the best and the benefactor of the World Cup. Greenpoint changed overnight. When that infrastructure went in with the roads and the fan walk, and you look at the paved walkways, and we are very, very optimistic about Greenpoint. Anywhere in the world, Greenpoint would be world class. It is, and it should be. It's right next to the waterfront. It's 5 minutes walk. Greenpoint prices are already up at the 40,000, 35 to 40,000, more like the 40,000 Rand a square meter. You want a 2-bedroom unit in Greenpoint, 18 to 20,000 Rand a month. Just want to intercede here. Bonds have been difficult. We know that. The banks have been difficult for good reason. And this is pushing the rental market. So you've got lots of people can afford to buy, but because they're commissioned, they can't get a bond, they're renting. So the rental market in the inner city has become very strong. And it's not only in the inner city, at Century City, we're already up at 12 to 15,000 Rand a month for a 2-bedroom unit. There's a massive demand for space. And therefore, we must be there to supply it. So that's the And then, before I get on to the final part, my summary, the planning issues and the environmental issues, NEMA and all these laws that have been put into place are making the rezoning of land almost impossible. Because if you've got one difficult person, one, can delay you up to 6-7 years. And he doesn't have to have a lot of money. He can duck and dive, and you get pro bono architects and pro bono attorneys. You do the work. And we've got huge blockages. Now, the city are aware of it. We are going to them. We're telling them. This is one of the big issues facing us politically in this country, service delivery. Let me put it into the vein of service. If you want to put in a sewer anywhere, you've got to go do an EIA. Why are you doing it? Why is it affecting the environment? We have to short circuit what they did in Australia. Melbourne's got 41 tower cranes going up at the moment in the CBD of Melbourne. Why? Because if a developer comes with a good product, with capital, with proper planning, he doesn't have to go wait in the queue for a guy that's building a garage. He gets, I wouldn't call it treatment, he's treated better, but he's in a queue whereby he's looked upon, and because time is money. To build these schemes, 4, 5, 6, 700 million, if you are delayed, it can wipe you out overnight. So we have to look at the environmental laws. There is a rationalisation taking place at the moment, but it's traumatic. And I don't think we're different to anywhere else in the world, by the way. It's the same in England, the same in New Zealand, the same in Australia. Although, if developers are respected and credible, and they've got big developments which are going to enhance the city, or there's an urban renewal project, or there's something that is benefiting the poor, they will get looked at in an efficient and correct way. We're not saying to the city of Cape Town, we don't want any shortcuts. All we want you to do is to work in the time constraints that the law puts forward to us. So, what can I say are the successes over a journey of 35, 40 years? Right from day one, we were in for the long haul. We understand that. We invest not for now, but for the future. There's no shortcuts. When you build and you develop, whether it be in the commercial market, whether it be hotels, whether it be what golf course estates, build the best, because it stands the test of time. Don't take any shortcuts. I can walk into any development and I can tell you that guy, he's done it on the sly. And most importantly, we've got clients still to date, 15, 20 years, that we still go back if the issues that need to be attended to. Your name and your brand is everything. That is what it's all about. So you stand up and say, I honor my brand, you are in the game. Of course, the track record, it hasn't always been easy. Believe me, it's not an easy game, the construction industry. The property industry is complicated, but it's rewarding. And at the end of the day, this country offers the opportunity of a lifetime. People say to me, but why don't you go to develop in London and wherever it is, Australia? It's easier for us to make 10 Rand than to make $1. So we have the opportunity, we have the rules, we have the people that want to buy, but the market's looking for credible guys out there delivering what they say they're going to deliver. We always, and most importantly, try to outperform the market. It's not always easy, you don't always get it right, but we are at this point in time in the cycle where technically, and we should be in a much weaker property market. Now I'm talking about the Western Cape Town. I'm not talking about the rest of South Africa. We do have projects in Joburg and Durban, but that's minor compared to the Western Cape. The economy, the growth in the GDP, at the levels that it is, we should be in a much tougher property market. But that's not the case. The property market is very strong in Cape Town. And I'm not only talking about the Atlantics and the inner city. I'm talking about Durbanville, southern suburbs of Cape Town. And what has happened is that the third and fourth and second home buyer market, people that own their own homes, are selling their houses quickly. So it's not taking 6 months to sell the house, it's taking a week. And that creates the momentum for the market, for people come to us who want new, they can come buy. You have lots of investors coming from outside South Africa, African investors. We have Angolans, we have Liberians, but they don't have Ebola. We have Nigerians, we have people coming. People want to come to this beautiful city of ours, this Cape Town, and they want to invest in property. It's not whether it's 3 million or 3.2 or 3.3. It makes no difference because they're buying in dollars anyway. So I am incredibly optimistic about the property. I've always been. We've been through the cycles. But even in tough times, it's not bad because a lot of the opposition goes away and we are still able to try and make products that work in tough times and adapt and change and adapt. Business is not just about property, it's about people. We have in the Rabi Property Group many loyal people who've been with us over 25 years. We're a big family. The Signature is a younger family because they're my children's ages. My two son-in-laws are with me in Signature. It's a different, they see things differently, the kids, and it's great. So I can think about things and they think about things that I don't even think about. And especially, of course, when it comes to the marketing and the social networking and all the different ways that we sell property today, you know, the property guide was always the one, the Bible. You know, that's not where it is anymore. It's on News 24. It's word of mouth. It's your networking and your below the line advertising and producing something that's of quality. So I just would like to leave those thoughts with you and say to the managers and to the guys that have put this together, to Neil, there's no better place in the world to live than in South Africa. We are brothers. We've got issues, but we can hold hands with the public sector. We are assisting certain role players to say, but maybe you shouldn't do it this way, maybe you should. We are a team. We live in those beautiful country. We are a beautiful people, and that's why we are South African. Thanks very much.
Thank you very much for that impassioned. I just need to know, do you have any daughters left? Yeah, right. Father-in-law right there. Dad, is it okay, Dad? There we go. I have a room full of witnesses. I'll invite you to the wedding, it'll be fantastic. Yeah, there's something about property people. It's that enthusiasm, it's that energy. It's that old thing that goes back to what Henry Ford said, that you can do anything with enthusiasm. And we create the visions out of a marsh. The public-private partnership, if you get beyond the tension of this is them and they are there and they have this expectation and you work together, we find solutions through everything. The man whose name is on the reports, and you know, it was quite something for me to start working with Erwin, because I used to deal with the public sector, and you're doing a lease agreement with public works, and you're trying to get a rental. And you sit down and you say, no, in this property, for me to get a return, I'm going to offer it to you at $50 a square meter. And they say, no, man. Oh, yes. Urude Uti. I said, who's this Urude guy? Right? And then I get to meet him, and he's a vivacious young man. I remember doing a debate with him on SABC, where I called him a right-wing academic from Stellenbosch, but that was for TV. That was fine. I have learned to work well with him. We have hired bodyguards for him, because 2 years back he told the estate agents, the property is overvalued. Oh, I must tell you, it's overvalued. And he wasn't popular with them, but he's still standing and he's still safe. So ladies and gentlemen, please give your attention to Meneer Erwin Roeder. Okay.
Sweets on. I won't say I've got fond memories about this hotel, but certainly historic memories. This is the second time in my life that I attended an event here. The first time was, I worked it out, must have been 1979. And it was a SAPOA organized breakfast or some similar event. And the speaker was Professor Atti de Vries, then head of the Bureau for Economic Research at Stellenbosch University. And I can't remember a thing about his presentation apart from one statement. He said, and please note that was 1979, their research showed that South Africa's economy simply cannot provide houses for everybody. And I'll still remember how it shook me because of the political implications, 1979. Anyway, we're not going to talk about houses and the backlog in housing today. We are going to talk about how not to make money. Right. Obviously, property does not operate in a vacuum. So I always start off by shorthand the world prospects. That's what our forecasts are built upon. Those that you see there, the developed world must deleverage. It's going to take a hell of a long time. 5 years ago, I said it was going to take 5 to 10 years. I still say the same thing 5 years later. It's not a normal recession. I needn't tell you that. We all know it. This is a financial recession, and research has shown that these recessions take much, much longer to recover. Just to scare the hell out of you, just compare Japan since 1989, what's happened to Japan. Anyway, so don't overestimate the duration of this slowdown, this world slowdown. And then, of course, as I said, it can take a long time. And then, of course, we in South Africa have our very special problems. We are going to have a lower growth in the wake of low world growth and infrastructure constraints in South Africa. And I've been saying that for the past, I don't know how many years. So those of you who are here for the 10th time, maybe you can go home now because you've heard it all before. And of course, yes, we're also aiming at our own feet, unfortunately, including the Eskom debacle. I see in Business Day this morning on my cell phone, there's an article in there to the effect that one of the Treasury officials made a statement in Parliament that South Africa's Treasury is more or less at its limit of guaranteeing loans to state enterprises. So, the 800 billion we're supposed to spend on infrastructure, I've always been wondering where the money is going to come from. Right, and then of course, as you can see there, you can read for yourself, the fiscus is in a corner. We've got all these backlogs. The problem with not only South Africa, but huge parts of the developed world is that we've been living beyond our means for, say, 10, 20 years. And cheap imports from China and the East, and then you used your bank account in America especially as an ATM to finance your purchases of cheap Chinese goods and so forth and so on. Very lekker. And this, of course, is now coming home to haunt us, and we have to now start corrective action, and it's going to take time. Right, and in South Africa, as you can see there, consumers are highly indebted, and that, of course, has got important implications for the retail property market, not so. Yeah, and therefore disposable incomes also are going to be under pressure. It already is, and we see it even in our retail sales. Right. Normally, I don't like quoting people because it implies that I can't think for myself, but I thought this time around, Chris Hart, I've got a high respect for him as an economist. In Business Day, he made the following statement the other day. He said, the credit-based, consumption-led growth model has reached a dead end. Of course, when somebody agrees with me, then that person must be very intelligent. Right. As I said, because property doesn't operate in a vacuum, so all our forecasts are based on a certain assumed scenario of growth in the economy. And for better or worse, every 6 months we do a survey amongst the top economists of South Africa. And if you are an economist, you don't get that survey from us, you evidently can't be a top economist. And this is the latest forecast we got from them. Less than 2%, 3%, 3%. I still think that's probably optimistic. So just to make sure that you understand the risks that we are looking at, over the past number of 2-3 years already at these events, we also have an alternative scenario, which we call the 2% scenario, where we assume that GDP will grow at 2% flat per annum. And so I think more and more the economists in South Africa are heading towards the 2%, if you ask me. Right, first a lecture on the long property cycle. Property, unlike what many people will tell you, is very similar to any income-producing assets. It has got cycles. It's as simple as that. But on top of the business cycle, you also have a very long cycle, between 15 and 20 years. And it's not just in South Africa. In the UK, I recently read a book written by a UK academic on the construction cycle in the UK. And guess what? He came to the conclusion, 15 to 20 years in the UK construction cycle over the past 200 years or so. And of course, what comes first is not construction, but property. So, so it makes sense then that South Africa may have a long cycle too. What you're looking at here is the top graph is an idealized cycle. The long-term trend line is the reddish line, and that is building costs, replacement costs. Or alternatively, you can look at it as inflation, right? And around that long-term trend line, prices or rentals will oscillate over time, right? Except that the cycle is very, very long from bottom to bottom or from top to top. It's a very long cycle, 15 to 20 years. Now, to see it more clearly, you can deflate it, as economists would call it. You would take that rental or that price, and you'll deflate it by dividing it by the building cost index. And then Bob's your uncle, you get that long classic cycle. Now, important thing about that cycle, you'll notice that in real terms, it moves horizontally. There's no growth in the real terms. The trend line doesn't grow. Does this mean that property is not an inflation hedge? No. We'll come to that in a moment. Now, the rubbish of this world can make money going down the cycle because they know how to research their market, they do niche developments, they are not your ordinary developers or your ordinary investors. The rooters of this world can make money there, right? We can all make money with eyes closed while the market is booming. It's damn difficult to go out of business while the market is booming. The trick comes in and there are only few survivors every long cycle, the rubbish of this world. Right. Now, that was the theory. Now, in practice, what's happened in South Africa, you're looking at the broken red line is real office rentals in Joburg. The early years was in the CBD, and thereafter we spliced it, and then you look at Sandton, or the northern suburbs of Joburg. And the blue line is real house prices. And you can see the two were pretty well correlated, except that offices were more volatile because offices are, of course, a bit speculative. Not so. As we can see right now, the guys are going completely crazy in Sandton CBD, erecting office buildings for which they've got no tenants. Also note that, as you would expect from theory, in real terms, the cycle, the trend line is horizontal, right? And obviously there are huge buying and selling opportunities by playing the cycle. Important lessons to learn. In fact, the cycle is so long, as you can see here, there was a trough in 1960, there was a trough in 77, there was a trough in 1997, and so on. It's so long that on average, if you just follow the cycle as your guideline for investing and disinvesting, you'll have two opportunities in your working life to buy property cheaply, and you'll have two opportunities to buy property expensively, right? You'll also notice we incorporate the forecast here. We are now in 2014, there we are. The rest is a forecast. We are forecasting house prices in real terms to keep on declining. By real terms, I mean we have taken out building cost inflation in this case. What does it mean in practice? Our forecast is that should we have 6% inflation, then over the next few years, maybe house prices will grow at 3% or so. As to the number of sales, I'm coming to that at a later stage. Also note that we're not forecasting much of a growth in real office rentals, given our forecast of GDP. And please note that was the optimistic GDP forecast I showed you. I'll presently show you the 2% scenario. So in order to make money here as a developer or an investor, when this is happening, you've got to be smart. You can't just be every dog and every man and his dog. Or you go offshore. That's the other option, of course, where you know that markets are cheaper. Just to entertain you a little bit, what you're looking at here is a most amazing graph. It shows house prices in the poshest street in the Netherlands to wit in the Herengracht in Amsterdam. It's been the poshest street for 4 centuries. So there are very few places in the world where one street has been constantly the poshest street in a city without crime. Guys, it starts in 1628. That's a few years before Jan van Riebeeck landed here. And it ends, unfortunately, only in 2007 or 8, thereabouts, 2008. I say unfortunately because I can bet my last bottom dollar that it did this afterwards. And it was forecastable, it was foreseeable. It was hugely overpriced over there. Note how long the cycles are. And then there are cycles within cycles. Just one little thing. You might recall from your history books that the VOC, Verenigde Oost-Indische Compagnie, which founded South Africa in 1652, it was the most important company in not only the world, but in the Netherlands. And the fiscus of the Netherlands was completely dependent on this one company. Can you imagine? That is what I call risk. So when the VOC went bang in 1795, which happens to coincide with when the first British occupation in the Cape, guess what happened? And then the Napoleonic Wars followed. And Napoleon used the Netherlands as a milk cow, right, to finance all his wars in Europe. Just see how the economy collapsed of the Netherlands. You could see the economy reflected in house prices, provided you deflate them, right? That's how closely we are aligned, we as property people, to what's happening in the economy. You can't divert, you can't separate the two. And of course, this we had as a world phenomenon, not just in the Netherlands. I'll never forget, in 2007, I did some research for a Dutch housing company. They were going to do some developments in Paarl and Franschhoek, mostly Paarl. And so they asked me to do some research for them, which is fine because they don't know South Africa. So I did it and I presented it to them, and the whole team of them flew out. This is a big holiday in Franschhoek and so on, all very, very nice as tourists. So I gave them my standard presentation of woe and behold and, you know, all of that. And this one guy was sitting on, I don't know, there's somewhere, and he said to me, he turned around and said, but you know, the Netherlands, these things don't happen, you know. Anyway, they were socialists, well, they are socialists, so they don't have these sort of cycles, don't they? Right, we now know they do. United States, very similar situation. Now, I'm showing you the United States house prices to show you, to demonstrate that you would theoretically and in practice you expect house prices in the real terms to move sideways over a long period of time. Yes, you have a little bit of a cycle, but prices come down they revert to the mean, as the financial economists would put it, all the time. Why is that so? The answer is very simple. It's known as the substitution theory. Why would you buy a house at 110 rands if you can have it built by Ravi for 100 rands? Right. So So obviously building costs in the long run must play a role as the sort of trend line. It's so obvious. Of course, in the shorter term, you've got other factors working in, like interest rates and so on, which gives you that swinging, that oscillation around the mean. Now, look at America. From 1950, on this scale, prices in real terms stayed between 80 and 100, all the way, moving sideways. And then something strange happened on the way to the bank. In the year 2000, prices shot through the ceiling. So any blind man with a white stick could have seen, yeah, is something horribly happening. Right? This is a bubble. That's my definition of a bubble, by the way. If something goes through the ceiling. And of course, the inevitable then had to happen. Now, the difference between South Africa and the US of A is that the Americans, they've paid their school fees. They've had the correction to a very large degree. Right? You can argue not fully. You can argue that there is room for it to decline even further, depending on how successful the management, the macro management of the American and world economies are going to turn out to be over the next few years. But you can see, yeah, to a large degree, most of the risk has now been corrected out. Gee, I've just invented a new English word. Right, compare that to South Africa. We also had this, well, here we had a long period of underperformance, but that you can ascribe to two things. First of all, we had the political transition, which created huge uncertainties, of course, and then secondly, we were fighting inflation. Hoera, uiteindelik, and of course, you could only do through very high interest rates, so that were also depressing house prices, right? And then we had the correction, as in America, as in so many parts of the world, interest rates very low, everybody is spending, no end to it, and we haven't had the correction that the Americans have had, only partially. Now, what's keeping up those prices to a large degree is the supply side. The banks are so scared of making the mistake again that it's very difficult for developers to erect new houses today, unless they've got piles of cash. I think Mr. Ravi will agree with that statement. So the supply side is being inhibited at the moment, so very few new houses are being added to the stock, and this is holding up prices. But believe you me, the moment the banks start forgetting about the previous crisis and they start lending again normally, then of course supply side will recover, and this is going to bring down prices eventually in real terms. So I'm not forecasting a crash in house prices whatsoever. All I'm saying is that the potential for capital growth for house prices is low. By capital growth, I mean real capital growth, in other words, after having deducted inflation. I'm recovering from a flu, not a flu, a cold, and I'm on medication, so let's just hope my voice will last. Right. What else can one read into that? Not much. Right. Returns. In the end, it's all about returns, not so. When I was cutting my teeth as a property man at an institution in South Africa, the then boss, the word return, I don't think it was in his vocabulary. What counted in those days was the number of people reporting to you, that gave you status, and or the size of the portfolio that you were managing. That also gave you status. And return, well, it's property, you know, it's bricks and mortar, and just believe in it like religion. Right. I start off here with listed funds. Now, and you all know what a listed fund is, but you'll notice I take the period 1995 to 2030, that's more or less a long cycle. If you really want to manipulate statistics, choose your own period in the case of economics, right? So I'm trying to be honest with you, so I chose a full cycle, 95 to 2003. I could have chosen any other period and you would have seen much better returns than 15.2 in real terms, total return. Just to refresh your memory, total return means income yield plus capital appreciation, right? So this is the real measure. This is what you should compare with the CPI, in this case, 6%. So that was a fantastic, a phenomenal period. If you had invested on the JSE in a property fund, you would have done very well in most cases. Of course, it's not sustainable. And why is it not sustainable? Well, here's the reason. What you're looking at here is directly held property, total returns going back to the 1960s. 1962 to 77, that's 16 years. 77 to 95, 19 years. 95 to 2013, 18 years. So every time we're taking a full cycle more or less. And you'll see the total return in the first cycle was nearly 5%. The second cycle was about 4%. And the last cycle also extraordinarily high at more than 7% total return. Now bear in mind, these are returns for typically institutional property. So that's people who naively buy and hold. Especially in the olden days. Nowadays, your institutions would buy, hold, and eventually sell, and then buy again. In those days, they would buy, and they would hold forever. I'll never forget, I had a colleague at this financial institution, and when I pointed out to them the wonders of this long cycle and what the practical implications are for the cycle, at the top end you're supposed to sell, even though you're not going to, but you're still supposed to sell it. And I said to him, but why don't you sell building XYZ in the CBD of Cape Town? And he said to me, but we can't sell it because we'll never be able to buy it back. Right? And I think that probably demonstrates the difference between an archaic property mind on the one hand and your equity investors on the other who trade all the time. Important difference. Right. I would like to add, as a last point about the total returns, is that the international rule of thumb is for buy and hold strategy, or the management of an institutional fund, is a total return of about 4%, 4 to 5 in the real terms. It's an international rule of thumb. If you want to do better than that, you've got to do clever things. Either you become a developer, but of course that increases your risk tremendously, or you become a speculator of some sorts, or you're looking for niches, like we've been hearing here today, like old age, retirement homes, etc., geographic identification of geographic boom areas, and so on. Right, a little bit more about the residential market. What you're looking at here is residential rentals for Cape Town, and we're comparing flats with houses with townhouses. And we're starting in 2005, first quarter, and we said, okay, let's make the playing fields even in 2005. Boom, let's go. And you'll see that the red dotted line is houses, house rentals fared best for a long time, but there is now a convergence. And the latest growth rates of flat rentals is plus 3%, houses plus 2%, and townhouses plus 3%. So what are we saying here to one another? Is that rentals in the middle class markets are growing at less than the inflation rate. I'm talking here about the average house in the suburbs, right? I'm not talking about a Greenpoint flat where maybe things are different. We simply don't know. It also tells me that the consumer, this is further evidence that the consumer out there is under huge pressure because these very mediocre growth rates are taking place in spite of the fact that so little new supply is being added to the housing stock. Right. So what it demonstrates, once again, it takes two to tangle. You've got a supply side and you've got a demand side. And even though the supply side is constrained, on the demand side, the consumer is under huge pressure. And that pressure, by the way, is not going to go away soon. Okay, so those of you who are in the estate agents, or you are conveyancers, or you are valuers who do house valuations, please sit up and take notice. What you're looking at here is the real value of mortgage bonds passed and re-advanced for residential purposes. I say it's real because we deflated it. We took out APSA house price index inflation. We took out. So in a way, you could look at it as the number of mortgage bonds passed. You'll see here, looking back in history, it was going along horizontally, and then in the early 90s, we had this tremendous growth. And one can speculate about the reason for that. It's probably a combination of lower interest rates and a new middle class being created. At one stage, people were arguing it's because of the new black middle class being created. But in those days, I argued, but that can't be because about 1 million whites had emigrated after 1994. That has now changed, and I think many of those white emigres have, some of them, X% have come back, we don't know how many. And I think the bleeding has stopped because there are so few work opportunities outside our borders at the moment. So I think at the moment you can ascribe some of this growth that we've seen to a new emerging black middle class. But that, of course, was a cyclical spike. And I would argue that this is probably the trend line. And these, okay, I'm not going to go into that. That's a model we built to forecast it. And here's our forecast. A forecast of the growth in nominal value of new mortgage loans. And now we're looking at nominal values. We didn't deflate it. What you will see here is that for this year, we're forecasting no growth in nominal values of new mortgages. Next year, less than 3%. The year thereafter, 2.5%, and so forth and so on. In nominal terms. In other words, rand values. Now, if you were to deduct from that inflation, then you will see that we're not really forecast a growth in the number of sales. So that, of course, is unfortunately, and I'm just a messenger boy, guys. That's bad news for conveyancers and estate agents and whoever is dependent on the number of sales. I would like to add too, just to make Mr. Rabi happy. This, of course, is an average. Where's Dr. Where's our American, New Zealand, Dutch host? There he is, right. I'll make him happy. I'm going to make the point. It's an average, boys. It's an average. Right. Right. Medium-term prospects for house prices. Prices are still very high in real terms. So the potential for gradual decline are great. That's what it means. Consumers are under unrelenting pressure. Interest rates will rise for two reasons. Basel III, in terms of Basel III, banks are trying their utmost to balance their assets with their liabilities. Of course, in the books of a bank, the assets are the mortgage bonds, and the liabilities is you and I depositing on 6 months notice a few rands with it. So, because an average mortgage bond for a house is about 20 years or so, I would guess, you see there's got a huge mismatch there between the terms. So they're not all that keen on house mortgages. Also, the profit margins are very low on house mortgages. And then, of course, the interest rate cycle, as we heard this morning, interest rates will rise, still rise even further. Right. And, of course, banks remain aversion. Their risk aversion continues. And therefore, I'm forecasting that eventually prices will have to revert to their mean. Right, shopping centres. This graph just shows that the consumers are under pressure. I'm not going to waste time on it. What is of greater interest to those of you who are into shopping centre investments What we're looking at here is the estimated compound growth in trading densities of malls in nominal rands. Now, trading density is, of course, the turnover per square meter of your retailers in your shopping center, right? So we're comparing super regionals, with small regional, and then with the CPI. First of all, the long haul, over the past 10, 11, 12 years, super regional trading densities grew slightly greater than, at a rate slightly greater than the CPI, 8%. So that's good news, I would think, right? In spite of all the new shopping centers being added. Having said that, of course, there are only about 7 super regional shopping centers in the country, those greater than 100,000 square meters. But the smaller the shopping center, the lower this growth rate. Note that regionals, those below 100,000 square meters, only about 6%, which equals more or less the CPI. Small regionals, less than the CPI. That's over the past 11 or so years. Over the past year, this trend was maintained, with the smaller ones doing even worse. Right, so it supports a notion we've had for a long time, is that it's your middle-sized shopping centers that are worst hit since 2008, say, really about. And of course, the very small convenience ones are probably okay, but we don't have stats on them. All right, so that's quite interesting because we know that historically, shopping centers have always been the best property sector to have invested in over the past 40 years, 50 years. We know that. And that's what explains that on the JSE, those listed REITs, real estate investment trusts, or listed property funds, about 65% on average of them are invested in shopping centers. So if you think of listed funds, you think of shopping centers. Right. Now, what we've been looking at here is trading densities, turnovers per square meter of the retailers operating in your shopping center. But that's not the full story. We know that one of the biggest bugbears at the moment is operating costs that are completely out of control. More specifically, big problems are for retailers and for the landlords are wages, assessment rates for the landlords and for the retailers, because that's being passed on. Landlords are still trying to pass it on to the retailers. So assessment rates being the biggest one, and then of course electricity. Those are the 3 big expense items. Now, on the question of assessment rates, here's something interesting for your attention. I did recently some research for a panelist who was going to speak at the SAPOA convention. In the end, the panel master didn't allow him to say his mind. So I'm still sitting with this research, but don't know what to do with the research. So I thought you are the lucky people who is going to share it with me. Right. I went to great trouble and I got these figures from the municipalities themselves. eThekwini, Tshwane, City of Cape Town. I also tried Joburg, but I didn't get the specific figures for Joburg. So we're looking at 3 metropolitan areas here. What you're seeing is that since 2004 to 2013, the salary bills have been growing at 13 to 14% compared to inflation of 6%. So either the salaries of the officials themselves have been growing crazily, and or they have been appointing left, right, and center new officials to create jobs. Now, in the case of eThekwini, I can remember I actually looked at the figures. You can see very clearly in the case of eThekwini, they've been creating jobs because the number of people employed just shot through the roof. So that, that explains why non-residential landlords are in big trouble because we don't have the vote. The homeowners at least have the vote. So you can have homeowners rioting in the streets, burning tires. You imagine the middle class suburbs people doing that, complaining about assessment rates going through the roof. But I can't imagine non-residential landlords doing it. I don't think Mr. Rabi will do it. Right. For a long time, we've been suspecting, and I include myself, we've been suspecting that we are oversupplied with shop space. Because all you see around us is new shopping malls going up all the time. Especially the poor Joburgers. I mean, they are horrified at all the new shopping centers being announced there. So I thought, let's do some research on it. And the best I could come up with is to build, first of all, a time series. That's what you're looking at, a time series of the stock of decentralized shopping malls in this country. Now, the first ones were built in the very early 60s. So that's what you're looking at. All new completions, accumulative over time. So it's the housing stock, not the housing stock, sorry, the shopping mall, the mall stock that you're looking at there. Sorry, completions, not the stock. My mistake, sorry, the completion. So it's new stock being completed all the time. And to check our data, I compared it with Stats SA data, which is the broken red line, and you can see they coincide more or less, the new completions. But with a slight lag from time to time. There's a lag there, there's a lag there. And the explanation for the lag is that the Stats SA data, of course, chances are that those completion certificates, occupation certificates are only completed and issued a few months after the shopping center had actually started to trade. Right. You'll notice over a shorter period, the compound growth rate of new completions is 2.2% per annum. Now that doesn't sound too bad if you come to think of it, right? So in order to make sure that it's not too bad, we compared it with GDP growth, more completions. We compare with real household consumption expenditure and with real GDP. And please note that we're talking about the first differences here because unfortunately, not unfortunately, but it's a fact that new completions is nothing but the first differences in your stock. So you will see here that more completions, well, 2.25% per annum over that long period, over a shorter period, no growth in real terms, in square meters in other words, compared to these decent growth rates we've had. So it doesn't look from the data that we are oversupplied as a generalization. So Dr. Dolph, note, it's just an average. Right. Growth in retail sales, that's the other important indicator for malls, of course. What you're looking at there is the 4-month moving average. You can see the trend line is coming down. It's coming down more slowly than we all expected, because, and I think the explanation is probably that that's the one thing that we will all fight to the last ditch, and that is to retain our standard of living. But most certainly we know, and we know from other sources of data, we know that the shopping centers are under huge pressure. Right, offices. You've all heard the term shift, in the sector shift towards the tertiary sector. It's a worldwide phenomenon. Guys in the factories are becoming less and less relative to the guys with the ties sitting behind computer screens and making us all believe that they're actually working. And what we're comparing here with is, yes, growth in GDP services, that is white-collar workers in other words, comparing that growth, in other words, your typical office occupiers, comparing that growth with the growth in the demand for office space, measured in square meters. And you'll see there's quite a reasonable correlation, as you would expect. But the important thing here is that the purple line, office demand, has been in negative territory. In other words, it's been contracting since about 2008. And it's still below the zero line. It's still contracting. So there's no fundamental growth in demand to be expected from office space. So what we're seeing at the moment, with all these new office buildings being completed in so many parts of our, especially in Sandton and Cape Town, is you see tenants moving from, say, grade B space to grade A, to new grade A space, and vacating grade B. So it's musical chairs. So I'm afraid, even though fundamentally our office rentals are not expensive, and they're just waiting for Godot, they're just waiting for this upturn, this magical upturn. In the meantime, I'm afraid, don't expect much growth in demand. That's the good news, guys. I can't do better than that. Office vacancies are more or less at the long-term average, so I can't do better than that. Nominal grade A office rentals, Cape Town CBD versus Cape Town decentralized. This is an interesting phenomenon. Look at the early 90s. You see what was happening there? Cape Town CBD was lagging behind decentralized office space, their rentals per square meter. And guess why? Those of you who are too young to remember, the grey-haired people, we know what happened there. It was the CBD that was going to pot at that time. And then it was saved in the nick by the CID, by the private sector. And so you've got a convergence now, and that to me is an indication that the CBD of Cape Town is sound. It was quite, as opposed, it's about, as far as I know, the only CBD in South Africa that is same. Pretoria CBD rentals are doing not too badly at the moment, but of course they are massively supported by the government. Right, two scenarios. How bad news would impact office rentals. This is the 2.6%, in other words, the base case scenario, growing at 4% this year, 7% next year, and 10% the year thereafter. Whereas if we're only going to have 2% growth, then it will be about half the growth rate, which of course is slightly less than the inflation rate. So even in the worst case scenario, guys, it's not as if the office market in South Africa is going to implode. It's just that many guys are going to sit with huge vacancies. Similar for industrial. It's quite interesting that Cape Town, the Cape Peninsula, has been keeping up with the rest of the country, national, but the growth rate is 6%, which is not bad given where we are in the cycle. For Cape Town compared to a national of 4%. Once again, two scenarios comparing Cape Peninsula, this base case scenario with a 2% scenario, and once again, the lower scenario with half the growth rates more or less later on, because there's a lag there. The 9% becomes about 4.5%. Listed funds. As we all know that REITs have been doing, or listed funds, then listed property funds have been doing extremely well over the past 12 years or so. Which is amazing. In fact, they've outperformed equity as a generalization, which is quite amazing because in the long run, you wouldn't expect property to do better than equity. Why? Because property's risk is much lower than equities, of course. So there is a trade-off. In theory, there's a trade-off. Anyway, so the question is, why has property, when listed, been doing so well? And here's my attempt at explaining it. Debt leverage is positive. You've got positive gearing at the moment. You have had for a long time because of the very low interest rates. And of course, because of the very good rating, market rating, which allowed the REITs to buy directly held portfolios at earnings enhancing yield. Let me give you a practical example. growth point, for all I know, I haven't done the sums recently, they're probably standing at a forward yield of, say, 6.5 at the moment. But they could buy in, theoretically, a grade A portfolio of office buildings at, say, 8.5, right? So immediately you've got this earnings enhancing effect the moment they buy in another 100 million rands worth of office buildings, as an example. And then, of course, some of them have been investing offshore, which, of course, what with the weak rand has been benefiting them. Big question is, how long can this virtuous cycle continue, given the interest rate cycle where we are, and given that there's very little growth in market rentals at the moment, especially malls. Don't forget, about 65% of our listed funds consist of malls, right? So it's quite important to them how the consumer is doing. And so the risk is evidently high, and all analysts know that, except that, and I'll show you in a moment, I'm still of the opinion that I think the fear for listed property funds is exaggerated by the analysts. And here's why. Let's first take the higher growth scenario, the consensus scenario. This is what our model forecasts. That prices will grow in 2014, they will contract by 4%, grow by 5%, grow by 5% over the next 2 years, right? And income yields will be, as you can see there on the screen, giving you the early 10s total returns, right? If you add that to that, you get a total return estimation, right? So 5 plus 7 gives you, say, 12, 13% thereabouts total return. There, of course, your total return would be, say, 3% or so. Now, compared to the alternatives on the JSE or in BAs or whatever you want to invest in, it's probably not too bad a scenario. However, this is what's going to happen when you have only 2%, the low rate scenario, and you can see the growth rates as forecast now become, the total returns become less than 10%. Right. But that would still be in excess of inflation. So it's, depending on what your expectations are, probably not too bad. Right, market ratings, we are close to the end. Market ratings, which is a fancy word for capitalization rates of directly held properties. The good news about South Africa is that our property market, our directly held property market, is sound. And that is reflected in those cap rates. From 1990, you're looking at here, that was when inflation was very high, and South Africa was going through the transition and so on. And then inflation got under control, and here we had the Great Recession. And look, ever since the Great Recession, if anything, cap rates have been slowly but surely been drifting lower, 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 which is an indication of a very strong market. In other words, investors were prepared to pay slightly more and slightly more and slightly more for the same expected cash flow. That's what drifting down capitalizations imply. Compared to what happened in other parts of the world, especially here. So I'm told that the explanation I can offer why our commercial property market fared so much better than, say, the American market was, our banks were much more conservative, have always been much more conservative when it comes to commercial property. You won't get an LTV of more than 60%, and that's always been the case. And I'm told that in the heydays of America's boom, you could get 90% LTVs. So you may have a big investor with, say, a portfolio of $100 million, and the recession struck, and prices were decelerating, coming down slightly. So the next day, this guy gets a phone call from his bank saying, we want more equity. And then, of course, the only way this private investor can inject more equity into his fund would be to sell. And that, of course, created a vicious circle. It's interesting how much lower regional shopping center cap rates are compared to the other property types. And that, of course, is a reflection of our society in a way. That's what investors are saying. They're expecting much more growth from shopping centres than from office buildings. And maybe they have been right, historically, especially the bigger shopping centres, of course. South Africans have got one strength. We are very good at shopping. Chinese must still learn from us. Right, conclusions. World economy and the infrastructure backlogs are constraints on SA economic growth. Residential property is still overpriced. Sorry guys. Office properties are fundamentally cheap, but vacancies persist. Industrial properties are fundamentally cheap. Of course, because industrial property is not really speculative, therefore you don't have a vacancy problem. Highly indebted consumers face challenges. Thus, more cash flows will remain under pressure, especially malls in working class locations. There's a lot of evidence that your working class in South Africa, I'm afraid to say, is being hit much more than your middle class by this recession. It's a pity. It creates all sorts of problems, as you know. But the property market is fundamentally healthy, and I think analysts are unreasonably pessimistic about REITs. Based on consensus macro forecasts. Yes, the property market is going to go through tougher times, that is without a doubt. But, you know, as long as you're prepared to scale down your expectations and you say, whew, as long as I can get a return, a total return that's higher than inflation, I'm still okay. And that's what I think is going to happen to the REITs. Thank you.
I'm going to ask Erwin to have a seat on the panel. I'm going to ask John to join in. Dr. Dolf de Roos, we're going to have you up front. Scott, Neil, Jacques, are you still with us? Thank you. I've just received some breaking news, and I'm going to read it in as best a form as I can. Jill Marcus at the MPC meeting, who says, given due regard of notwithstanding the prevailing interest rate regime in our global counterparts, the august meeting at the Ruder conference in Cape Town gave us advice not to put rates up, so with deference to them, they are on hold. All right. Kim, can I ask your help? Can I get a microphone? Thank you. This, I think we've got two microphones, Kim. If I can get one to my panelists, and then one can be the roaming. Ladies and gentlemen, this is Kim. The Wealth Migrate forms that you have, if you can give them to the young lady. Just the forms, not your number. Just the forms. All right, this is the money shot. We've been in this room all day. We've heard the speakers present their theses and what's in their minds. We would love to hear what's in your minds. Comments, queries, suggestions, antitheses for the gentleman up there. Do we have a question from the floor? Thesis, antithesis, synthesis. The young lady in the front.
Hi, Edwin. Yeah, I was just thinking you showed that graph of residential property that showed reasonable growth for 2 years, and then it seemed to fall down to about 5% and then stick at that level. Why, when it sort of reached a certain level, do you expect it to drop back?
I forgot to allude to that. Over the past year or so, we've seen a little growth, 6, 7, 8% growth in nominal growth in house prices in South Africa. the three banks actually agree on that one. The three indices agree for a change. And the question is why? And I've been puzzled with it about it for a long time, and I've now come to the conclusion that the most plausible explanation is that banks have maybe started to relax their credit criteria. The question is, how long will that last? I'm actually glad when they're relaxing it, because that will mean in the end we'll see more housing developments. But at the moment, because there are no new housing developments or very little taking place, it means that on the supply side, prices will stay relatively high for a longer period. Now, okay, I shouldn't express an opinion of whether that's bad or good, but that is my explanation for what's been happening recently. I can't think of any other explanation. At one stage, I was thinking how maybe there's a correlation between the JSE's boom and house prices, but I don't know. I think it's a bit far-fetched.
Thank you. I've got a question from Mayor Duval right at the back. You'll find him. He's the bald-headed guy. It's okay.
Thank you. I've got some interesting stats here related to bonds. If you look at the number of bonds that was granted on a national basis on a quarterly term, for the first term this year, 38,000 bonds were approved. And if you look at the quarter before that, the last one in December, 43,000. So it's quite a significant drop. And this middle term, there was also 43,000 a number of bonds. This is stats from the National Credit Regulator. It's amazing that although there's a sentiment that the market is very buoyant, and it's actually, you speak to agents, they say that the market, there's a shortage of houses, the number of bonds have dropped about by 5,000 bonds less per quarter. So it means that the bonds are lower, and if you look at the market for below 15,000 Rand income, it's actually staggering how few bonds are approved. If you look at the stats from last year, for people that earn less than 15,000 Rand a month, they took up 13 billion Rand in one term in unsecured debt, and only 1.3 in bonds. So you imagine how many houses they could have built from 13 billion. So what do you think is the impact of the African bank status? Because all the banks will become nervous now again to lend out money because they are picking up some of the risk. So to the panel, what do you think this will impact into the market of banks actually now also become a little bit more nervous to lend out money, particularly on the home loan side?
Well, if I may take that one. First of all, one must be very careful to look at stats like that on a quarter-to-quarter or month-to-month basis because of seasonalities. Could be all sorts of problems. Even the platinum strike could have affected it. Having said that, I wouldn't be surprised if the number is maybe not coming down sharply, but starting to move sideways. I'm talking about the number of mortgage bonds passed. There's anecdotal evidence that your so-called affordable segment, that developers in that segment are struggling to sell, so they become, per force, they're becoming landlords. I don't know, Mayor, whether you can, whether you have any evidence to that effect, but that is the anecdotal evidence I have from one developer, and that's not maybe representative.
No, you'll see that recently Old Mutual created another R1 billion fund to buy property from their own developers, which they have granted fund in terms of a development impact fund. So the developers couldn't sell their properties, so Old Mutual had to bail them kind of out by creating a R1 billion fund to buy these houses and now starting to rent them out. But obviously they have to have an exit strategy, and they're trying to offload 10% of this per annum. And that's where the rent-to-buy concept actually gets in quite well. But the main thing is that a lot of developers moved into holding the stock rather than selling because they struggle, particularly in the market with 75% of your household goes into debt and people are struggling to raise home loans.
You see, that's further evidence that the working class segment of our society is under huge pressure. In fact, Etienne in Johannesburg, Etienne, what's his surname? Economist of REIM. He made the point.
Etienne Leroux.
Leroux. He made the point 2 days ago that at the moment, inflation rate for working class people is actually about 8% plus, compared to say the 6% for middle class people, because of things like food prices, which are running at a higher rate. Yes, I'm afraid our society is under huge pressure at the moment, and yeah.
John Robbie, just a question. Signatura has gone very top end. If we look at the distribution of households and household income across South Africa, our median point, half the population lives on a household of 3,500 rand, so we can exclude them out of the market. In 12 million households across the country, it's perhaps that last 1 million of 12 million households in the country that can afford property. At the very bottom end, we have state intervention, RDP houses, a questionable strategy. Can we sustain that? At the top end, you've got Signatura. Where does the man in the street, the guy who's relying on that 15, 18,000 rand income level, where does he fit in the property space in South Africa?
Very good question. Look, let me put it this way. There's going to be the affordable housing market, and there's going to be the various stages up to the top end of the market. It's almost impossible for us as developers, certainly in Cape Town, in the Western Cape, to produce anything under, if I'm talking about, let's define it between single residential housing on a plot, as against apartment living. So let's just look at apartments as an example. For us to produce anything under 1.5 million is almost impossible, even if I put my land in at next to nothing. So the cost of building today is running at around, for us, around 15,000 rand a square meter. And you factor that in, 1.5 million is bottom, and I promise you there's very little margin in that. So where is the guy who earns 15,000 rand a month, where is he going to fit into the cycle? He's going to rent. That was my point. He has to rent until he's in a position where he can get into the existing market, where you can go buy houses in the existing suburbs, get his foot in the door, and then scale up. When you look at the affordable housing market, do developers make money? I have not known in all my years, and we've been right through it, where developers are successful in the affordable housing market. And that's why that was our model, that the affordable housing market needs to be cross-subsidized by some type of subsidy from the state in one form or another, to be able for it to get and contact. Because once you get the guys in at 500,000-600,000, you start to create the market, because inflation will take and they'll sell for 800, then 1.2, and off they go into the property cycle. So to answer your question, where does somebody who earns 15,000 to 20,000 rand a month buy at the moment? That's a big, big problem. We can't supply that.
If I may come in on this one, Mr. MC, sorry, I'm monopolizing now.
It's your party. You can cry if you want to.
It supports my view that for a long time now, that we are far too owner-oriented in this country. In Germany, 55% of the population rent. And you can't complain and say they are armgatte, the Germans, The Swiss are 60% of them rent. It's the normal, it's a question of a different culture. In South Africa, I get the impression that to rent, there's some aspersions are leveled at people who rent, as if there's something wrong with them. And I think that is changing through necessity, is changing in our country at the moment, as occupation becomes more and more expensive. Of course, the long-term problem is who want to own a house and rent it out if you can get a return only of 5% net on that house, So that still doesn't necessarily, in the shorter term, solve the problem of the supply side that is lacking at the moment. So by all means, it seems that rents will also have to rise sometime in the future. At the moment, it's not rising by much, as I showed you. But in the longer run, in order to make new housing construction viable for owner investors as opposed to owner occupiers, rentals will have to keep on rising, especially if interest rates are going to rise again.
Dolph, we have the phenomenon in this country. Our listed sector is 280 billion rand strong. Of that, of our REITs, perhaps, and it's if you add it up, and the transactions have come through in the last 2 or 3 years, perhaps only 4 billion of that is in the residential space. How does that fit in a world in the United States where you have the massive REITs, equity residential, monster REIT up there, probably worth more than our whole capitalization of our REIT industry in one company focused in residential? How do you balance that anomaly?
I don't think it's an anomaly. I think it's going to change. What you were saying a moment ago about the proportion of people who are renting going up, that is a trend that's going to accelerate, because in our parents' generation, and I mean ours generically because we're all slightly at different stages, but they had one job and they worked for a lifetime and got the golden watch. And in my generation, you might have 2 or 3 careers, and young people today expect to have 20 different careers. I come across so many people who say they don't even want to own their own home because they're not sure what the economy is doing in their domestic economy. They might go and live in Europe for a while, and if they don't like it there, if the economy doesn't work, they'll try Asia or something. They're far more mobile in their outlook. It comes back to what we were saying before about the world is shrinking and getting smaller and getting more global. So the nature of desire to own your own home, I think, is changing. Turkey, ironically, for a long time had the highest proportion of home ownership, followed by Australia and New Zealand. And that's changing too. So REITs, I think, are going to be dwarfed by crowdfunding. You might say of a personal interest, it's a self-fulfilling prophecy on a desire level. I don't think so. I think this is a real phenomenon. REITs have had their day. They're still good, but the trend we're seeing that's happening, and this came out of the conference we were at in New York, is that there are still a lot of REITs around, but they're already so outdated that as they reach the end of their life expectancy, which generally is about 20 years, in the past, a new REIT would take them over, but now they're just being sold off. And what are they going to be sold into? Either redevelopment work, or they're going to be refurbished, and then a crowd-funded entity is going to take over the assets of what was erstwhile in a REIT. So I know this is sort of a circuitous way of answering the question, but I think we've got this phase shift happening in the world, and it's all good. There's no right or wrong, it's just the way it's happening. At the end of the day, the population of this planet is increasing at an alarming rate. Malthusian theories are still in the fore. So that's one phenomenon that's still occurring. We've got people with changing desires as to where they want to live and how they want to live. The idea of a house, a single-family home in the suburbs with your proverbial quarter-acre lot is diminishing. Yeah. People want, and someone mentioned it before, they want, did you say lock and leave was the expression, or, lock and forget. And I personally like that. I've lived in a condo-style environment for a long time now because I travel so much. I like the idea that when I close the door behind me and that's the only point of entrance, I don't need to worry about anything else. I think that's a trend that's increasing. So it's just a natural evolution of how we live. And I think we can get a bit too hung up on looking at ratios and stats and performance. Go with the flow. Talk with young people. I know that if you want to get wise information, you talk with older folks because they've got the experience. But often old folks are stuck in old ways of thinking. And I learn more from talking with young people and seeing what music they're listening to. Do I always like the music my daughter listens to? No.
I hope not.
No. But it does me good to listen to it and find out what the lyrics are and find out what her friends are talking about and find out what interests them. Because theirs is the way of the future. And if we, even at our stage, want to succeed in this game of real estate, we can't teach the young people what worked for us 20 years ago. We've got to learn what their trends are. And I think that's the secret to staying mentally fit and also being one step ahead of the game.
Yeah, and I know you thought when your daughter was playing you wrecking ball, you was a demolition site, but... Question from the floor?
Yeah, I've got a question.
Thank you.
Hi, good evening, good afternoon, panel. I don't agree with the commentary with regards to the Germans of the world and the European markets that are now showing more signs of or desirous to rent as opposed to ownership in our country. And I think Mr. Rabi alluded to it in his speech of government subsidised first-time home buyers, government employees being subsidised for housing. In all our years through the apartheid government, blacks were, people in our country were not given the opportunity of land tenure. And that is the separation, as I see it, between those that have today some sort of asset base, something to cling on to, has been taken away from those people, and now we want to continue to suggest that that is a trend. I have a problem with that philosophy.
Okay, I can share some stats with you. I looked it up quite recently. In 1994, because the 1913 Native Land Act precluded black people from buying property in 93% of the country, there were 497,000 records registered in the deeds office in black hands. By 2014, that number had increased to about 2.7 million, but that's of a total of 6 million registered deeds. If you look at where the trends are currently, the fastest growing market segment, 53% of new applications for mortgage bonds are first-time buyers. Of those first-time buyers, single black females are the most exciting category in that space. But I'll share those statistics with you from Lightstone did that research for me. But I think that's the turbo boost in this economy. I think the release of that pent-up demand is what this country's growth is reliant and depending on. But I interject. I'm just asking questions.
And if I can add to that, I take your point. And you made it, you don't need a panel when you've got an MC like this. But I think we've got to distinguish between two phenomena here. One is the trend that we feel ought to be happening for the benefit of the country, and another one is an observable, measurable trend that is actually happening. And the two need not be in alignment necessarily. I agree with you, and I'm a big proponent. I've written books on this as to why real estate or property ownership is beneficial to the individual and therefore the country. But that doesn't mean to say that that's what's actually happening. And for the young generation, their reasons not to want real estate might be very valid in their eyes. It's just like we have no control over population growth. There are only 2 countries in the world where their native population, say native in that sense, but where the population of nationals of that country is shrinking. One is Japan, where they're currently at about 128 million, and they expect to be below 100 million within one generation, not within 100 years, within a generation. And the other one is Germany, where its population is shrinking, and were it not for the importation of what they call guest workers, they would in fact be in decline. And that has major impacts on the real estate market. The other trend that comes into it, and that's sort of just alluding to there are more factors at play here, is the propensity for families to be shrinking. The number of children per couple is going down dramatically, which changes the need for housing. So all these factors come into play, and all we can do really as participants in the market is observe and measure what's going on and see how we adapt our strategies for the benefit of either our shareholders or our funders or ourselves or whomever we're doing this for.
I'm going to take a couple of more questions from the floor, and then I'm going to get the panelists to give their concluding comments. And me and Dad are going to leave and sort ourselves out. Hey, Dad. A couple of questions from the floor.
I'd like to just answer that question on the wealth effect as well. I think one of the things that's held most people back is 2 things. The first one is education. So it's very easy for me to buy a house because my father bought a house, and when I was terrified, I went to my father and he helped me buy the house, etc., etc. So education is now accessible to everyone. You don't have to go to Harvard anymore. You can go free on YouTube or TED and literally find out the same information. And I think that people all over the world will watch videos like on TED about the wealth effect and the impact that property has on people's wealth, and they will want to partake in it. The second thing has always been the gap between how much money I've got and whether I can invest or not. And yes, there's countries like Australia where the government gives you a 5% deposit, etc. But in general, people just don't have the ability. And as technology improves, the education will rise and the ability, the barrier to entry will drop. And that, when those 2 graphs intersect, that's when we'll see. And that's really what we were talking about with that Project W Wealth. You don't have to own an entire building to benefit. You can own the door handle.
The democracy of capital. Sure. Sure. You've paid thousands, giving you one more chance to ask the experts a question or two, or 3 or 13. Okay, I'm going to have closing comments. I'm going to go with Neil.
Yeah, just extending a little bit on the comments of investing versus renting. I think Scott touched on it. I mean, I'm very passionate about the whole education process for investors, and it is so accessible anywhere, to get the information. Once you start getting your first little bit of success, it almost catches you like a bug, because you pretty much realize, and I went through this sort of transformation myself. I made money through accident, through buying and selling a number of properties over a number of years, and then of course when the financial crisis came along, I didn't know what happened too. There were harsh lessons learned there too. So, but the whole thing is that we're learning all the time, and I think that's the most important. Just to touch a little bit again on this whole sort of rental market. The new market, I mean, I touched on it today, was, it's a very strong technology-based market. They tend to be on the move, and they like to move from place to place quite a lot, and they tend to stay in the high transportation nodes. And so it's a very different type of renter that is around today. They're more mobile, they're on the move, and they want a bit of diversity in their life. They don't want to be stuck in one place for too long. So the whole concept of investment for them is very different. For investors, that's a good thing, because you hopefully are getting a good tenant, hopefully. So just from that sort of perspective, I think if somebody's not sure, get into the market. There's different ways that you can invest. I think, like John's whole version where they take a property, okay, he's in a very particular sector, and they change the whole look of the property. I mean, there's also ways that you can convert from residential to commercial. In fact, Erwin, your offices are in a residential node which has been converted to. So there's different ways that that value can get out of property. So absolutely, the education thing is big, but I think once a bug catches you, get some success, and and I think that is the thing. Get that first little bit of success, and I think it happened to you, John, and then the next one follows from there on forward.
Sure. Over to Dolph, Dr. Dolph de Roos.
I agree with that, Neil. And again, I think one of the benefits of coming to events like this is you get different points of view. If we were all in agreement with each other, if we never had questions that said, and I respect the fact that you said, I disagree with this. If we were all in alignment, we'd be redundant to each other. We'd all be sitting, listening, and nodding our heads. So it's good to have different points of view. They say the mind is like a parachute. It works best when open. And the challenge is, many people think they've got an open mind when it's merely vacant. So the fact that you're here shows that you're willing to open your mind to possibilities. So thank you very much.
Maybe. Scott Picken.
No, thanks for a wonderful day. I've learned a hell of a lot. And just from the last thing I would say is that if I'd said to you 20 years ago that you would do all your business by email and on your mobile phone, you would have looked at me like I was mad. Today, if I said to you, you're not allowed to check your email for 6 months and I'm taking away your phone for 24 hours, you would think your life was about to come to an end. I can guarantee you that crowdfunding will have the same impact on your property career in the next 10 years. And just from a perspective of trust, I deposited 18,000 Rand in Martin's bank account at 12 o'clock today. Never met Martin before. And at 3 o'clock, he dropped off my 12 tickets to the rugby game at Brendan, my business partner's wife's house, in 4 hours. I've got the picture if anyone wants to check it out. That is the literally right happening now, social proof. And if you just think of what can happen with tickets, imagine what will happen in the investment world.
Before we get to Dad?
We have to sort out the Lobola question, please, my brother. Can we go outside and have a discussion? I like big fat cows.
Look, I helped Kulubuse out with his situation, so
it's asking about the property market, about ownership and rental. I think let me just comment on that. We have inflation. inflation has, and I think Erwin will understand that when he mentioned that about the institutions, where institutions just held on to the property and didn't want to sell. They weren't geniuses, but that inflation, with rentals going up every year 10%, created inherent value. Now, inflation is a quick increase in value of house prices. If you're buying in the right area, and you're not buying out there you're buying in the right areas, you are going to have a 10% inflation in your prices, and your property is a good investment in this country. We've proved it over the years. We're continuing to prove it. It's not always going to, and if you take prices are going to come down, they're not going to come down in the really established areas where you've got transportation nodes. You know the My City bus service around this country, the VIA service in Johannesburg. You're going to have value in your property. No question, and it is your single biggest asset, and people aspire to have their own home. So, I understand the renting philosophy. I understand what Erwin says about Germany. He's quite right, except the percentage is 75% of Germans rent. But we're going to have that happen. It's going to be a combination. As Dolph says, there's going to be markets within markets. But they cannot take away that a house is a person's single biggest asset and is the leverage going forward to create wealth for a family, individual, or single. Thank you very much. Can we leave now immediately?
No. My single biggest asset is the marriage certificate I'm going to have with your daughter for you to be my father-in-law. To end it off,
Yeah. Well, I think the most important thing about property is that it's a forced way of saving by owning it. Its performance is not the best. We all know that. Everybody acknowledges that. So equity, if you were to consistently invest in equity, chances are you'll do much better. Unless you are going to argue that with property, the big advantage of property is that you can gain. But given where we are now in the cycle, gearing is not all that lucrative. That's the first point I would like to make. It's a forced way of saving. And the second important thing is that, and we're now here more on social grounds, I think many politicians tend to forget that it's not property. Wealth doesn't start with property. It starts with income. Because income allows you to finance property and then to get capital growth through that. So if you want to grow income, as my colleague has said, then of course you need education first. Everything starts with education, and that's where this country is falling flat.
Thank you. Ladies and gentlemen, you've invested a day with us. You've been here at the REIM Investment Conference. The Ruder products are up available on the screen. Scott and his team in Wealth Migrate, if you want to have the conversation about going offshore, are standing outside ready and waiting. John Robb, if you want to buy a 1.7 million rand property, I will only charge you 7.5%. We're family now, so I'll negotiate my rate down. If you want to pick up one of Dolph's books, there are lovely young ladies waiting there to take your cash. It has been a joy. I love and understand real estate, and I think about it in the middle of the night. And it's been a pleasure to stand up with you and some of the great minds that we've operated here today. I'd love to continue the conversation. I'm on Facebook, I'm on Twitter. That's pretty much it. My name is Kura Chiota, and it's been an absolute joy and pleasure being with you. So until next time on Ask the Property Experts, from me in the studio and my wonderful team here, goodbye.